SoFi has gone up 200+% since the lows in April 2025. And institutional and retail investors are talking about SoFi like it's the next Palantir. So in this video, I want to go through their services, their products, just overall business model, see if they have a moat. And then I want to go into their financial results. They recently reported their earnings. And I want to look at some news articles and sentiment around the business. And then finally, I want to look at a stock valuation analysis of SoFi using my stock valuation software. So if you like this content, please like and subscribe. It really helps my channel grow. And with that, let's get into this video. SoFi operates with three main revenue generating segments: lending, financial services, and their technology platform. And so they started with lending back in 2011, 2012, and they started with student loan refinancing as their service. And so they were the first company to do that, and that's how they got their name in the door. But since then, over the years, they've gotten more sophisticated with their services and products. They started offering lending products. They started offering mortgage loans, personal loans, home equity loans, in-school loans, and other things like that. So their lending segment has gotten more sophisticated. Then you have their financial services, which are B2C offerings, which is business to consumer. And so these are directly from SoFi to their members. And these are things like SoFi credit card, SoFi money, relay, and other things that generate value for their direct members and members subscribing to them. And then finally, you have their technology platform. And this is a B2B offering, so business to business. And this allows businesses that are clients of SoFi to offer financial services to their customers. And so you can think of this, if you were to think of an analog, you could think of PayPal's Braintree as a similar segment to compare against this technology platform segment. I want to point out this blue box here because I really think it speaks to their brand and moat around their business name. So they have naming rights to the SoFi Stadium, which is the home of the LA Rams and the LA Chargers, which are huge teams. They're the presenting sponsor of the tech-infused Golf League. They're the official banking partner of the NBA, NBA G League, NBA 2K League, and USA Basketball. And they're presenting partner for the Country Music Association's festival, the CMA Fest. You can see how the brand and marketing team at SoFi is really driving SoFi's trust and brand recognition with the public. And so this will allow a lot more consumers and customers and even business clients to use SoFi because they will think of SoFi when they need a loan. They'll think of SoFi if they need a business offering to their own customers going forward. I want to show one more slide here right after this one about this one-stop shop for digital financial services that SoFi promotes. And this is their ecosystem. This is how their members can stay in SoFi's ecosystem and use whatever product they need for their financial life. So I think this really speaks to the moat most of all, that members of SoFi can do banking, they can do credit cards, they can invest their money, they can get any type of loan with SoFi. They don't really need to leave SoFi's ecosystem to do anything. And we can see why this is so important and critical because just take a look at NVIDIA. It's a totally different industry, semiconductors. But their CUDA software allows them to have a stranglehold on on businesses who buy these chips because it's so hard to use somebody else's software with their chips. You can't. It's a closed ecosystem basically. So likewise, here in SoFi, they have this financial services ecosystem where members can bank, credit card, invest, do loans, and they don't have to leave SoFi to find a financial service that SoFi doesn't provide. So I just want to go over a few more slides just to get a better sense of the business for SoFi. So the first slide that I want to go through is the diversified revenue slide. And what stuck out to me in this slide was that they're saying that revenue has shifted to a more capital light, fee-based revenue. And so if this is true, that means that they're going to have really high margins and really high revenues year over year from their fee-based revenue. So if they break that down in the 10Q, which we'll see later, we'll see a nice increase in fee-based revenue. And you can see in these charts that they're increasing percentage-wise the fee-based revenue in contrast to all other forms of revenue. And they're guiding for a larger and larger segment of fee-based revenue from their services. In addition, it looks like their financial services segment has been driving a lot of revenue. They're saying here financial services has driven 2x net revenue growth on the year while nearly doubling contribution margin. So it's growing rapidly and providing more and more contribution to the overall revenues generated from the company. And then here we have diversified lending capabilities serve more members while maximizing returns. What they're saying is they have a balance sheet, and on that balance sheet, they will keep loans that are high quality that they can service. But then they take some of the maybe other loans that they don't want to keep on their balance sheet, and they can sell those. They can sell those to other loan buyers who can use them and take them and do what they want with them. And then they also securitize some loans. So they have so much flexibility in what they can do, and they have so much control on what loans they want to keep on their balance sheet. They have full flexibility and control over, let's reduce the balance sheet, let's increase the balance sheet. They can do whatever they want. And that way they can keep their platform healthy in terms of revenue generation and optimize how much revenue they're getting from their full balance sheet, full portfolio of loans. And they also have secured financing, and saying here, financing is provided to asset buyers to purchase tranches of SoFi originated loans. Loans are originated on behalf of third parties to meet their predefined criteria. They have a LPB, loan platform business, LPB referrals. So they're getting money from all different sources. So here we have lending originations, and I really want to look at the home loans because that should be depressed right now because, interest rates are relatively high, home prices are relatively high in certain niche markets around the country. So when the housing market truly recovers, they should see an increase in the home loan revenue by a large margin. I've pulled up their statement of operations here. You can see that they've broken down their statement of operations by interest income and non-interest income. So they do this because their lending segment is a large portion of their revenue, and that produces interest from all these loans. So interest income, their loans and securitizations came in at $738.86 million versus $621.06 million a year ago. And that's a great increase to see, over $100 million. And then their other segment was basically unchanged. And so that makes their total interest income $792.4 million versus $674.6 million. And so this really speaks to why their growth rates are so high. As you can see, their interest income alone has increased more than $100 million. And so you may know what loans are, but securitizations are basically taking illiquid loans and things like that, vehicles, financial vehicles like that, and then packaging them up and then allowing them to be bought by asset buyers, which turns an illiquid asset into a liquid asset. And so they're getting interest income from that. And so those are what securitizations are. So just like you would have cost of goods, you have expenses to get this interest, to generate this interest income. And those interest expenses are detailed after that. So for securitizations and warehouses, they had $29.65 million versus $17.36 million. For deposits, that's pretty much negligible change, $233.23 million versus $231.8 million. Then they have corporate borrowings, relatively unchanged, actually went down a little bit, $11.5 million versus $12.725 million. And then others, so minuscule that won't even mention it. So that brings the total interest expense to 274.57 million versus 262.01 million. And so this went up slightly, but you can see how much more their interest income went up compared to how much their total interest expense went up. So they're doing great in that regard. So that brings their total net interest income, just for that segment, the interest income segment, to 517.837 million versus 412.584 million. So you're seeing a 100 million plus increase in the net interest income. Then we have non-interest income, and this is income that is not generated from interest from loans and other things. So here we have loan origination, sales, and securitizations and servicing coming in at 70.85 million versus 61.5 million. And that's a pretty good increase in that number and that line item. Then you have technology products and solutions. This is their technology platform. And so that came in at 90.8 million versus 85.9 million. Then you have loan platform fees. And this came in at a whopping 127.4 million versus 12 million from a year ago. So we really need to dig into the investor presentation to see the discrepancy, why there's such a huge discrepancy and increase in this amount of income. And it could be just off the cuff, it could be from increased members, it could be from increased usage of the platform, it could be from an increase in the price of the services, of the fees. So we really got to dive into this number and see why there's such a huge increase there. Also a nice increase in the other non-interest income segment, 48.05 million versus 26.6 million. And so this brings the total non-interest income to 337.1 million versus 186.0 million from a year ago. And that brings the total net revenue from total interest income and total non-interest income to 854.94 million versus 598.6 million. A huge increase in the net revenue. After they reported the total net revenue, they are reporting the non-interest expenses to make the non-interest income. So they have technology and product development, which is basically their R&D for their technology platform. 152.14 million versus 132.1 from a year ago. Then they have sales and marketing, 264.7 versus 184.7. Cost of operations, 150.4 versus 109.7. General administrative, 165.4 versus 145.0 from a year ago. Their total non-interest expense was 732.7 versus 571.6. So along with the huge increase in total net revenue, you see a big increase in the expenses, total non-interest expenses. So that all boils down to the net income. And so their net income came in at 97.26 million versus 17.4 million a year ago. Then that brings their diluted earnings per share to 8 cents versus 1 cent, which is a huge increase year over year. So let's move to the cash flow statement. And here they have net income starting with the operating activities. So the net income came in at 168.37 million versus 105.4 million a year ago. And they're doing the 6 months, not the 3 months. So the net income will be different from what you saw above. And then they have adjustments to that net income. And so the biggest thing I want to point out here is the change in loans held for sale, net. And a decrease here, a bigger negative number here, means that they increased the amount of loans that they have on their balance sheet because they used more cash to acquire more loans. So that accounts for this huge difference here, which is the net cash used in operating activities. So it came in at negative 1,445,400,000 versus a positive 253.87 million. That all leads to cash and cash equivalents restricted at the end of the period to 2.714 billion versus 2.731 billion. So relatively unchanged there with the cash and cash equivalents. They still have a large amount of cash on their balance sheet. So finally, let's go through their balance sheet itself. It's always assets, liabilities, and then looking at the total liabilities and shareholder equity. So here we have cash and cash equivalents, which we saw in the cash flow statement. Total assets, we have 41.11 billion versus 36.25 billion. So they increased their total assets by $5 billion over this time frame. Then we go to liabilities and permanent equity. Their liabilities, let's just go to the total liabilities, 34.25 billion versus 29.72 billion. So their liabilities also increased about $5 billion. So total liabilities plus their permanent equity, well, let's do total permanent equity first. So total permanent equity is 6.86 billion versus 6.525 billion. So there's about 300 million roughly increase in the total permanent equity, which is great to see. And then total liabilities plus permanent equity equals the total assets above. So I pulled up two articles about SoFi, and the first one is bearish and the second one is bullish. And the first one is talking about the valuation cannot be explained, the price to sales, the price to book, the P, the PEG, they're all overvalued in SoFi's case. And to this, it is correct. Those key metrics are overvalued and very high compared to the industry and sector standards. But also, you have to look at the fundamentals for the company in terms of their moat and their business. Like I said before, they have an ecosystem which offers all sorts of financial services for these members that are using it, that are in that ecosystem, including the businesses that are in the B2B ecosystems. So those things, those network effects are hard to value with numbers. And I think that if SoFi can keep that competitive edge and that to fight off competitors and maybe can justify these overvalued key metrics. Also, I need to mention that this is not a traditional financial company. It's not a Bank of America. It's not a JPM. It is a software tech play as well because of their technology platform, because of all the money they spent on research and development of these services, these financial services and technology platforms. It's going to take a lot for them to move to another financial service provider if they're already receiving great customer and experiences with customer care and experiences with SoFi and are already embedded in their ecosystem. If they already have a personal loan with SoFi, they're not going to easily refinance that loan with another provider, especially when there's fees and other things involved in that move. So I think SoFi has the edge right now, and they have the ecosystem and the support system to handle this for now. Also, they have other positives too. Their management is driving strong growth and cross-selling, and that's justifying these high growth rates that they're seeing in their numbers. So that is bolstering the share price too. They have like a following almost. I wouldn't say this is a meme stock, but it has a really good following of investors, retail investors with this company. So the second article that I pulled up is more bullish on SoFi. So here they are talking about that there should be a re-rating from analysts, from big analysts ahead for SoFi. And the reasons are multiple tailwind factors that they mention here. Some of the major ones that I want to point out are the exposure of SoFi to mortgage financing. So there is a extreme for both housing supply and building permits volume. So housing supply is at a cyclical high and building permits is a cyclical low. And so when the normalization happens, when both of these come back to normal, that will lead to a very big increase in mortgage demand. And so that will be a tailwind for SoFi, who does mortgage originations and mortgage loans. So another thing that I mentioned here is that there's going to be Fed cuts. That is almost guaranteed at this point, because if you look at the FedWatch tool, it's overwhelmingly saying that there's going to be a cut in the near future. And the Fed also indicated this from their recent Jackson Hole symposium. So we know cuts are coming, and this is only going to bolster the pressure on the 10-year rate, which will pressure the mortgage rates going forward to go down. And when those mortgage rates go down, the mortgage demand will rise, which is also a tailwind for SoFi. Analysts right now are kind of discounting. They have price target that's lower than the current price of the stock. I think these analysts are going to have to re-rate and change their estimates going forward. Let's bring up this stock in the stock valuation tool. And so here I pulled up SoFi. And a couple of things I just want to point out in this is that their trailing 12-month PE is 49.9x. Their forward PE is 73.5x. So there is a huge increase in the forward PE versus the trailing 12-month PE. And so this indicates that there's high growth in the company and potential overvaluation, but we have to see based on the numbers going forward in the next few quarters to see if they can sustain these high numbers. So finally, I want to go through value projections for the company. And I've changed this section up to have bear, base, and bull cases. And I've added multiple of earnings valuations, which is based on the PE ratios and the EPS going forward. So it makes a historical ratio and then uses that to figure out the 2026, 2027, 2028, and 2029 numbers for the stock. And these are all estimates, obviously. They're estimates, obviously, based on just a historical ratio. And so here, SoFi is automatically categorized by the software as a financial company. But like I said, it's hard to value SoFi because it could be treated as a software fintech company as well, which it is. So what I thought we'd do is look at the excess return valuation first for bear, base, and bull cases, because that is the traditional model used to model financial companies. And then we switch that to a DCF model to see what the value would be there. So looking at the bear, base, and bull cases, the excess return model suggests that the price to book for this company is relatively high, and I believe it's around 6. A higher price to book ratio is bad. So I think SoFi's is around 6 last time I checked. And so that's what leads to this excess return valuation being so low, because the high price to book ratio. But then let's see what happens, and these are just different. The bear, base, and bull cases just have differences in the PE ratios and the revenue growth rates. So in the bear case, the revenue growth rate declines by 1, and you can change these numbers. These are all editable inputs. For the base case, the revenues just stays the same, and then the revenue growth on the bull case goes up by 1. And you can change this to whatever you want. So for the bear case, you could say it's going to drop by 5% every year. And you can see the numbers change there. This is not changing. The fair value for the excess return valuation is not changing when I change the growth rates, because it's not based on that. It's based on the price to book. So that's why this is not changing when I change these numbers. But these multiple of earnings valuation numbers will change when I change the price to earnings, because that's what it's based on. So now that we've seen the excess return valuation on the bear, base, and bull cases, we can look at what happens when we change this to a DCF model, which would be more in line with a software company that I would be valuing through the software. If you notice this, as I changed it to a DCF model, it changed it completely. Now that it's using the revenue growth rate, and that's flowing down to the net income and the EPS and everything, it's changing the discounted cash flow completely. But now going from $5 to $65 of fair value. So it really depends on how you value SoFi. For right now, I'm not buying these shares in the public account. I would love to see a market correction and see these shares closer to $20 or under $20 if possible before I acquired any shares in the public account. Just because the relative valuations are a little bit elevated at the current moment. I do believe that it's totally possible that analysts revise and re-rate this and those metrics catch up to the financials, to the growth rates that we're seeing in this company. And I could totally see this being justified. But for right now, I want to take a more cautious approach. And if it does drop, I'll be the first one on these shares and see where they go from there. So thanks guys for tuning into this video about SoFi, its business, its financials, its moat, and where I think this stock could be headed in the future and the valuation. If you like this content, please like and subscribe to my channel. It really helps the YouTube algorithm push this content out to more people who like this content. And with that, I'll see you guys in the next one.